and being here in person. Members have the option to appear in person or virtually. For generations, manufacturing was the lifeblood of communities across Ohio and Pennsylvania and South Dakota and throughout the country. It was heavily unionized and the jobs paid well. Not a coincidence that those things go together. Those jobs allowed generations of Americans to build a middle-class life. Workers innovated on the shop floor, propelling our economy to new heights, allowing us to lead the world in developing new industries. Ohioans, though, know all too well what happened. Beginning in the 1970s and 1980s, we stopped making things here. Look at places like my hometown of Mansfield, Ohio, an industrial city of 50,000, halfway between Cleveland and Columbus. Companies like Westinghouse, Tappan Stove, Ohio Brass, General Motors closed down one after another after another. Go to any town in Ohio and people can name a similar list. They now too often measure their local history in lost opportunities, lost plants, lost jobs. All over America, companies were moving production elsewhere in the name of efficiency. Efficiency was essentially business school speak for lower wages. Corporate America wanted cheaper labor wherever they could find it. First, they went to anti-union, anti-worker, low-wage states, often in the South. Then, when even those wages weren't low enough for corporate America, they shut those plants and moved overseas. When these companies moved out, they weren't replaced by new investment. The creative destruction that the market fundamentalists like to talk about, it wasn't followed by construction, creative or otherwise. Corporate greed, aided by decades of underinvestment, bad trade policy, which these corporations lobbied Congress for, worse tax policy, which these special interests also lobbied Congress for, drove production overseas. It left us reliant on other countries too often, our economic competitors. It exposed us to supply shocks. It gutted our middle class. Ohioans and workers in historic industrial towns felt it first. Now the whole country feels it in the form of higher prices, empty shelves, months-long waits for products people need. We need to make things here in America. That's not going to happen on its own, not when the economy of the last 5 decades was built on corporations hopping the globe in search of workers to exploit. Not when countries like China steal our ideas, then they monetize them and use them to compete and often cheat against American businesses and American workers. We need a concerted, coordinated effort to invest in American industries. We need to reverse decades of bad policy and instead invest in our greatest assets, American workers and American innovation. Look at what's happening right now in Bucyrus, Ohio, a town about 30 miles west of where I grew up. Few innovations more quintessentially American than the light bulb. Every elementary schooler knows that Thomas Edison from Milan, Ohio, invented the light bulb at his lab in Menlo Park, New Jersey. Ohio became the center of light bulb manufacturing. We've seen plants close across my state in places like Ravenna and Warren. We're told these plants were old and dated. They made old-fashioned incandescent light bulbs. Instead, Americans would make new next-generation technology like LED bulbs. Well, not exactly what happened. We just learned that 2 Ohio factories that were part of the LED light bulb supply chain in Ohio, Bucyrus and Logan, southeast of Columbus, each are closing their operations. Today, promises made, today 99% of LED light bulb production is in China, 99-point-something%. Think about that, 99% of the production's in China. Promises made. When you move the entire production overseas, you move the shop floor innovation right along with it. Again, corporate America underestimated the ingenuity of American workers. They usually do, or they just didn't care. Or let's look at semiconductors. American research and development created these chips, American companies did most of the manufacturing. Yet over time, production, often fueled by incentives from foreign countries and betrayed by American tax and trade policy, this production moved overseas. Look what happened. During the pandemic, companies in Ohio and Pennsylvania and all over shut down production lines, laid off workers because they couldn't get enough semiconductors. Whether you are Ford Motor Company in Lima, Ohio, Whirlpool in Clyde, Ohio, Navistar in Springfield, Ohio, you need these chips. In the semiconductor industry, we see the problem, we see the solution. At the end of January, I flew to Columbus to join Intel to announce the largest ever domestic investment in semiconductor manufacturing. It will create 10,000 good-paying jobs. 5,000 of those will be union tradespeople working for 10 years to build this facility. It's possible because we're on the verge of passing an historic investment in American innovation in manufacturing. We need to pass this bipartisan legislation that supports efforts like Intel's to build new production here. Our bill invests in research and development and manufacturing throughout the country to enable us to compete for jobs of the future. That builds on the work we did with the bipartisan infrastructure law, which will create new jobs and allow us to move more goods more quickly, shortening supply chains. That's how we build a more resilient economy that can withstand global events, whether it's a public health crisis, a geopolitical crisis, or a climate crisis. We need to invest in our workers, ensure they reap the benefits of the economic growth they create through good-paying jobs and investment in training programs and affordable child care. Taken together, these investments ensure that economic growth reaches the whole country. We need to support local and regional efforts to drive innovation. I'm submitting a statement for the record from a coalition of business, industry associations, and nonprofits in Northeast Ohio and how supply chain resilience affects Ohio's economy. I ask unanimous consent that the coalition's letter be submitted for the record without objection. I'm working closely with them to support their application for the federal challenge grant that would help turn the region into a national hub for advanced manufacturing innovation, the kind of effort we need in communities all over the country. We can lower prices, we can speed up supply chains, we can better compete with China, we can create jobs and economic growth in places that corporate America helped to kill and then left for dead decades ago. I'm excited to hear from our witnesses today about how we can make smart investments that will spur innovation and job creation. We'll hear from experts on the unique nature of supply shocks triggered by the pandemic, like semiconductors, and how we prevent them in the future. We'll talk about how we can best support American workers, American innovators, and we'll talk about investments in domestic manufacturing. It's time to make things in America again. Ohio has buried the term Rust Belt. It's time for a whole country to bury it. Senator Toomey.
Thank you, Mr. Chairman. Just to get an important fact out there on the table, if you look back to find that year in which total manufacturing in America reached an all-time high, you look way back to find that year. Wait for it. It's 2018, basically flat in 2019. Then we had a decline from COVID. And this year, we're on track to set a new all-time record for manufactured goods in the United States of America. We have never made as much stuff in this country as we will make this year. And then we'll break that record probably next year if the economy is strong. I think it's important to have that perspective. Hearing today is about supply chain resiliency. Of course, the Banking Committee is talking about supply chains for one reason. That is that inflation has hit a 40-year high. Under President Biden, consumer prices have risen by 8.4%. That's more inflation than under the entirety of the prior administration. Even though wages are rising, prices are rising faster. And that's causing workers, especially lower-income workers, to fall further and further behind. Milton Friedman said, and I quote, "Inflation is taxation without representation," end quote. Now, Democratic policies are hiking that tax. Rather than course correct, our Democratic colleagues have been trying to shift the blame for their inflation tax to anyone else. One of their favorite scapegoats has been the supply chains. That's, of course, in addition to blaming greedy corporations, Republicans generally, and Vladimir Putin. Actually, inflation is pretty easy to understand. It results from more money chasing fewer goods. The Biden administration's policies have limited the economy's ability to produce some consumer goods, and Democrats' reckless spending has resulted in more money chasing those fewer goods. As an example, consider the president's war on American energy independence. In 2020, then-candidate Joe Biden promised that in his administration there would be, and I quote, "no more ability for the oil industry to continue to drill, period," end quote. On day one of his administration, he started to make good on that threat. He stopped all new oil and gas leases on federal land and ended the Keystone XL pipeline project. Even before Russia's invasion of Ukraine, gas prices were up 40%. Now the administration is going on bended knee to plead with Venezuela's illegitimate dictator to produce more oil that America is quite capable of producing and exporting. On the spending side, former Obama administration officials Larry Summers and Jason Furman warned that Democrats' reckless spending spree would cause inflation. Yet with inflation at 8%, most of my Democrat colleagues still support another deficit finance blowout spending bill. So today we're going to set the record straight. First, inflation did not suddenly accelerate simply because global free trade somehow made our supply chains fragile. Global trade has provided tremendous benefits to Americans, and if anything, has made our economy less fragile. Rather, supply chains are struggling because fiscal policy has overstimulated demand. For example, because of high demand, port volumes have hit record levels. Second, Democrats' far-left agenda would continue to make inflation worse, not better. Where to begin? Democrats are pushing for price controls and for antitrust laws to reduce economic efficiency. And my Democratic colleagues continue to push for this reckless tax and spend Build Back Better plan that will further fuel inflation and harm our economy. Amazingly, the White House now claims that even more deficit spending will lower inflation. Now, that just defies belief, and you don't have to take my word for it. Last month, former Obama administration Treasury official Stephen Ratner wrote a New York Times op-ed entitled, quote, "Biden keeps blaming the supply chain for inflation. That's dishonest," end quote. Steve Ratner said the president's claims about supply chain disruptions are both misleading and simplistic. He asserted that the bulk of our supply problems are a product of an overstimulated economy. Now, while supply chains are not to blame for inflation, our recent experience highlights the need to enact some sensible reforms that could improve supply chains. These reforms could include making U.S. ports more efficient by increasing their use of automation, which obstructionist unions have long blocked, and eliminating harmful tariffs that increase transportation costs and bottlenecks by reducing the supply of needed equipment, like truck chassis. In addition, to help fight inflation, it's time for the president to abandon this domestic agenda he's been on. He should end the war on American energy that has led to higher prices for American families. The president should restart the Keystone XL pipeline, should be expediting natural gas pipeline and LNG facility approvals, and should repeal the broad and punitive regulations and restrictions on American oil and gas production. The president should also drop this reckless tax and spending plan that would dramatically increase the size and scope of government by expanding the welfare state and fueling still more inflation. The best approach to achieve economic growth is to unleash market competition, the engine of economic growth. Congress can focus on three areas: cutting through the jungle of red tape, preventing new entrepreneurship, innovation, and competition; eliminating government-created barriers and distortions to Americans working and saving; and increasing opportunities for global trade and getting rid of protectionist special interest. To help us understand these issues today, we'll hear from two experts on global trade and fiscal policy. Phil Levy, the chief economist at Flexport, a leading supply chain logistics company, and Vero DeRugi, an economist from the Mercatus Center at George Mason University. I look forward to hearing from them about the importance of free trade and free markets for creating strong and resilient growth and common sense solutions for increasing growth and lowering inflation. Thank you, Mr. Chairman.
Thank you, Senator Toomey. I'll introduce today's witnesses. Dr. William Spriggs, professor of economics at Howard University, chief economist of the AFL-CIO. He previously served as assistant secretary for the Office of Policy at the Department of Labor, as a senior advisor at the Small Business Administration. Welcome, Dr. Spriggs. Dr. Betsy Stevenson's professor of public policy and economics at the University of Michigan. She previously served on the Council of Economic Advisors and as chief economist at the Department of Labor. Welcome, Dr. Stevenson. Dr. Erica Fuchs, professor of engineering and public policy at Carnegie Mellon, where she leads the College of Engineering's Moonshot Initiative on national technology strategy and critical technologies, supply chains, and infrastructure. Welcome, Dr. Fuchs. Veronique DeRugi is George Gibbs Chair in Political Economy at the Mercatus Center at George Mason. She previously was a resident fellow at AEI, policy analyst at Cato, and a research fellow at the Economic Research Foundation. Welcome, Dr. DeRugi. Phil Levy's chief economist at Flexport. He previously was senior fellow in the global economy at the Chicago Council on Global Affairs and senior economist for trade at the CEA during the George W. Bush administration as a member of the policy planning, members of policy planning staff for the State Department. Dr. Levy, welcome. Dr. Spriggs, please begin.
Thank you, Chair Brown, for this opportunity to offer this testimony on behalf of the AFL-CIO America's House of Labor, and based on my experience as an economist at Howard University. We are in an unusual moment. We have not seen price volatility of this sort in about 50 years. The analogy to the previous time we saw price volatility of this type in the early 1970s and the late 1970s, when we had oil shocks, when we had wars, and we had two major hurricanes that disrupted production, has led many people to think that those supply shocks should be viewed as benign, and the real issue was demand, and people want to think the current situation of price volatility is similar. It's not. So I just want to walk through this issue of price volatility, and by that I mean that month-to-month price changes, the variation in month-to-month price changes have peaked at an unusual level. They are receding on their own right now. To walk through how the supply chain can affect things, remember that if you stop the ability to buy one good, you're going to have people look for substitutes. The lack of chips for the auto industry has led to the greatest decline in production we have seen over the last 40 years. So as an example, in 2019, when General Motors forced a strike on the UAW, we had a strike that lasted from mid-September to the end of October. Total U.S. auto production only fell by about 20%. Last year, at the worst of not being able to find chips, production dropped 60%. This is a collapse in auto production. We've not seen that before. We have only gotten back to around 58% of the production that we had in the pre-COVID January of 2020. That's a huge drop in supply over a prolonged period. We simply have not had that. The result is that the price for new cars has gone up, not because demand over the 2-year period was excessive, but simply you can't function if you're going to make less than half the cars you used to make. That sent the price of cars up by about 10%. It meant that the price percentage points to the total inflation was about 0.4, 0.5. If I can't buy a new car, then I'm going to buy a used car. So we shift the demand curve out for used cars. The demand curve for used cars resulted in a prolonged spike in used car prices that generated 1.7 of the points. Of the 7.9 points in inflation, 1.7 is just from the seeking of a substitute for the new cars, which we are not producing, which we are only being able to make at the lowest level ever. And of course, if I can't buy a new car and a used car is too expensive, then I repair my old car. And so we have another little bump up in inflation from the shift for more auto repairs. In total, that comes to over 2.3 points of the 7.9 points. About 30% of inflation is just because we cannot get chips. To say that this is not dealing with a lack of supply, General Motors right now would be making every car they could because people want to buy them. They can't. But these supply shifts and the ripple effect have repeated themselves throughout 2020, whether it's Vietnam having to shut down a plant because of COVID, or India having to shut down because they had to divert oxygen to their hospitals, or China shutting down ports. We need a more resilient economy. We need Congress to pass the CHIPS Act to address what we now know was an overconcentration of chip manufacturing in the hand of just a few companies too far from the United States, and we need more competition in that space. We need Congress to look at the supply of labor and the passage of the Build Back Better to ease frictions that are keeping women from returning to the labor force. These are steps that Congress can make to recognize that we live in a world with higher risk, global, geopolitical, and we hope never another pandemic. Congress can make this different for us going forward. Thank you.
Thank you, Dr. Spriggs. Dr. Stevenson, welcome.
Thank you very much, Chairman Brown and Ranking Member Toomey and distinguished members of the committee for this opportunity to speak to you today. Both GDP and the labor market have recovered at a much more rapid rate than many predicted. Unemployment's fallen to 3.8%. People have the confidence needed to look for better opportunities and leave their current jobs, and they're finding better opportunities. A recent Pew survey found that more than half of workers who quit a job in 2020 were now earning more money. They had more opportunities for advancement and improved ability to balance work and family responsibilities. Indeed, the V-shaped recovery that members of Congress hoped for when they passed those many spending bills to help Americans recover from the pandemic has materialized due to those efforts. Now, that same survey, though, found that among parents who had quit a job, nearly half said they had quit because of childcare issues. And that highlights a challenge I want to speak to you about today. But let's start with the dark side of the economy, inflation. While inflation captures a generalized rise in prices, it does not mean that all prices are rising similarly, and Professor Spriggs articulated quite clearly that there's a concentration in inflation in the goods-producing sector. I share some of Senator Toomey's enthusiasm for trade, and I would say to you that our urgency, therefore, to support trade is to vaccinate the globe. Similarly, within the U.S., containing COVID is essential to keeping the economy smoothly operating. The last COVID surge in January did not lead many people to lose jobs, so it's not showing up in the data that way, but it did lead to millions of people missing work due to illness. Availability of tests, vaccines, well-ventilated buildings helps boost productivity and ensures that workers are healthy enough to meet the demand of customers. A healthy and robust labor supply is particularly important for the service sector. To put in perspective the size of the manufacturing sector in today's economy, we produce a lot more stuff in today's economy, but it's really shifted towards the service sector. When we entered the pandemic, we had 1 million fewer people working in the goods-producing sector than we had at the beginning of the 2008 recession. Today, 84% of private sector workers are in the service sector. And for much of the past year, the service sector has not experienced the upward price pressures of the goods sector. Inflation in services, excluding energy, is running at 4.4%, and most services are well within normal inflation rates. Medical services, just 2.4%. Education and communication services, just 1.7%. But don't take this as good news, take it as a warning. These low rates of inflation, combined with low labor supply, is why services are where our most significant risk to ongoing high inflation lies. A rise in inflation in services could have a devastating impact on overall inflation, even if the price increases for goods begin to abate. The economy remains short 1.4 million workers, particularly prime-age women, whose labor force participation rate is down relative to pre-pandemic levels and down relative to prime-age men's labor force participation today. Women exited the labor force and lost jobs at higher rates during the pandemic than men did. And yet, in every other recession the United States has ever experienced, it's women's growth in labor force participation that helped pull us out of the recession. Between 2015 and 2019, women took way more jobs than men, and those jobs were largely in the service sector. 1 in 4 women work in education and health services, that area where we have yet to see high inflation. But this and the rest of the service sector is poised for a rapid recovery in demand over the coming year, as consumer demand for services is likely to rise as the pandemic wanes. But will there be workers to meet that demand? There are 2 critical steps you can take to ensure that workers, particularly women, return to the labor market. The first is to ensure access to care services such as childcare and home nursing care. Research that I outline in my written testimony has shown that caregiving responsibilities keep women and men out of the labor force. Remember that stat. Parents just told us that their quits were driven by care concerns in 2021. The second step is to increase funding and improve access to training programs, particularly for vocational and community college programs. Enrollment in community colleges declined nearly 15% during the pandemic. Enrollment in health-related programs declined nearly 10%, education programs 12%. Enrollment's fallen most for first-generation students and underrepresented minorities. These declines are bad for the potential students, but they're the Achilles heel in our supply chain resiliency. The slowdown in training in some fields is a harbinger of potential labor shortages that will translate into an increase in prices. As employers compete for a dwindling supply of workers with the needed training, wages will be bid up to the point that the additional costs will need to be passed on to customers. The time to act is now. Thank you.
Thank you, Dr. Stevenson. Dr. Fuchs, welcome.
Thank you, Chairman Brown, Ranking Member Toomey, and members of the committee. Early during the pandemic, I spoke with a medium-sized U.S. medical supplier capable of manufacturing 9 million masks per month. Surprisingly, their most challenging bottleneck was elastic ear loops. When discussing critical technologies, we wouldn't ordinarily think elastic. Yet during those early months of intense supply shortages, that lack of elastic cost our country millions of masks a week. A similar story could be told in how the current shortage in semiconductors is stopping cars from being produced and leading to job losses in Michigan. The solution to these problems are not as simple as just stockpiling masks or reshoring manufacturing. In the case of elastic, what was missing was the capability to pivot, adapt the equipment, change the elastic, change the mask to not require elastic, change the regulations. In semiconductors, what's needed is to redesign the chips. I will highlight 3 steps towards building a resilient economy and the cross-mission critical technology analytics our country needs to implement these steps. First, the U.S. must build timely situational awareness. Otherwise, we're flying blind. At the time of the COVID outbreak, the last data collected by the Economic Census on all domestic manufacturers was 2017. While the government convened large leading companies, they estimated that they had the capability to meet only half of domestic demand. What they needed, however, was not more firms, but better tools. Leveraging automated text analysis of public data, my colleagues and I created timely situational awareness of U.S. domestic manufacturers entering, pivoting into, and scaling up in response to the COVID crisis, particularly small and medium-sized firms unknown to government. Within 2 weeks, we have revealed significantly greater domestic mask and respirator manufacturing capability than known before. The government needs these modern data analytic capabilities. Figuring out which products and supply chains have sufficient national value to be tracked preemptively will require cross-mission valuation that aggregates across defense, health, labor, equity, and commercial interests. Second, the U.S. must create the supply chains of tomorrow, not fix the supply chains of yesterday. Innovation can transform supply chains and our competitive position therein. Most batteries for electric vehicles require significant cobalt, the majority of which is mined in the Congo and refined in China. As the world scales up electric vehicle production, innovations such as in cobalt-free batteries could reduce and even eliminate such regional specific risks. Semiconductor chips used in transportation and defense systems are highly heterogeneous and custom designed to single manufacturing facilities. Government funding of common design platforms would reduce the cost of switching between facilities and increase supply chain resiliency. It would also increase the aggregate market power of these sectors critical to security and the economy. Third, the U.S. needs to rebuild its manufacturing ecosystem through investments in infrastructure. In our research on domestic manufacturers pivoting during the pandemic, what was left of the U.S. manufacturing ecosystem was central to the U.S. response. In Wisconsin, the founder of a waste management and construction company MacGyvered broken mask manufacturing machines into working for commercial scale production. In Indiana, a company leveraged its expertise in filtration materials and oil absorbent products to pivot into making melt-blown polymers for masks and later also N95s themselves. These pivoting companies' previous experience in waste management, construction, and water or oil infrastructure strengthens my belief that the greatest promise for rebuilding our manufacturing ecosystem may be equitable, country-wide investments in infrastructure of the future. Infrastructure for transit, energy, communications, and data address needs of society and manufacturing. Done right, investments in smart, climate-resilient infrastructure of the future can build national capabilities in the companies and skilled workers who become the manufacturing workforce of the future. Going forward, the U.S. needs to build the analytic capability to identify win-wins across missions. My research shows that certain innovations in areas critical to national security, including high-end semiconductors for communications and cobalt-free batteries, offer better jobs for hardworking high school graduates. Similarly, in the case of the current semiconductor shortage, government funding of design platforms that embrace commonalities but leave room for differences across the technological demands of the defense and commercial sectors can lead to a solution where the sum is greater than the parts for U.S. security, economic, labor, and equity interests. To ensure future U.S. security, competitiveness, and access to critical supply, the U.S. must establish a forward-looking, cross-mission, critical technology analytics program able to build timely situational awareness, quantify the value of innovations to transform our geopolitical dependencies, and identify win-win pathways across national missions.
Thank you, Dr. Fuchs. Dr. Duvergy.
Oh, sorry. Chairman Brown, Ranking Member Toomey, and Senator Brown, thank you for having me today and giving me the opportunity to testify. You have a copy of my written testimony, so I'd like to focus on two key points today. So first, fiscal and monetary policy decisions are the key reasons for the inflation we face. Second, while supply shocks should not be ignored, they are not the main cause of inflation. So first, the United States is currently experiencing an 8% inflation over the past year. The key reason for this burst of inflation is government-induced demand. The U.S. Department of Treasury first issued $3 trillion of new debt, which the Fed quickly bought in exchange for $3 trillion of new reserves at the Treasury, which then, in turn, sent it to payments to Americans. The Treasury then borrowed another $2 trillion or so to send out another round of payments. Overall, federal debt rose by almost 30% of GDP over 2 years. This response was crafted on the mistaken assumption that the pandemic-induced recession was mostly an aggregate demand shock, not one of aggregate supply caused by the lockdown and the pandemic. Under these circumstances, sending money to people was going to have little impact on output while greatly affecting demand for durable goods. The size of the fiscal stimulus was also a problem. Even by Keynesian standards, the COVID relief was larger than any plausible output gap. The deficit spending of $1.9 trillion in the American Rescue Plan in particular was much larger than the projected $700 billion output gap through 2023, the period when most of the spending would take place, and at a time where unemployment had reduced quite significantly. Whereas everyone from the Fed chairman to monetary experts spent most of 2021 explaining inflation without any mention of fiscal and monetary policies, economists such as Larry Summers and Jason Furman were sounding the alarm that excessive spending would boost aggregate demand to the point of overheating the economy and cause inflation. They also objected to the inconsistent but widespread narrative that this inflation was mostly due to supply shock. Several studies confirm the demand-side effect of inflation. So what about supply shock, such as supply chain choke points? What about shift of demand from service to durables? I mean, these factors cannot be dismissed, but they are not the main cause of inflation. First, there wouldn't be such a supply chain issues without the massive increase in demand for durable goods fueled by government spending and money creation. According to the WTO, artificially inflating demand for goods accounted for 65 to 75% of supply shortages. Second, global supply chains are global. If inflation were truly the product of global supply chain issues, we would witness roughly the same level of inflation throughout industrial nations. But we don't. Most industrial countries have much lower level of inflation than us. These other countries also implemented significantly lower level of COVID relief. Finally, one needs to differentiate between supply constraints, which increase the price of some or even many goods relative to other prices, and inflation, which occurs when the price of everything, including labor, rise. We are now seeing the price of everything go up, and wages, too, also rising, though for now at a lower rate. Supply shock and constraints do not cause that broad-based pattern. In addition, price level hikes caused by supply-side shocks are generally not ongoing month after month price hikes. They are usually a one-time price level jump, which eventually dissipates when the supply shock is over and indeed usually reverses, resulting in a period of measured deflation. Again, here, all prices are rising. The inflation is persistent and there is no sign of a reversal. The bottom line is the inflation we have is for the most part a fiscal and monetary inflation. Controlling it requires strong Fed actions, but also significant fiscal restraint from Congress. Short of implementing both, inflation could persist much longer at the expense of the most economically vulnerable in our society. However, be aware that our level of debt has made controlling inflation harder and will make it much more fiscally painful. Thank you.
Thank you, Dr. Duverger. Dr. Levy, welcome.
Thank you. Thank you, Chairman Brown, Ranking Member Toomey, and Senator, for this opportunity to testify today on the performance of supply chains through the COVID-19 pandemic. Even from a purely economic perspective, it's been a time of extraordinary shocks, unprecedented policy responses, and shifting economic behavior. One salient outcome has been disappointment in the performance of global supply chains. In my testimony, I'd like to address the question of why this happened. Why did we not continue to enjoy the ready availability of goods at moderate prices to which we had become accustomed? I'll focus on two potential dominant causes and then argue for a choice between them. I'll close with a thought or two about supply chain resiliency. The first explanation I'll offer attributes the shortages and the price hikes the country has experienced to a failure of global supply chains. Over the course of the pandemic, we saw periods when factories around the world closed due to COVID infections or were operating at limited capacity. We saw infections and restrictions hit truckers, warehouses, rail, air, and port operations. It is inarguable that the pandemic posed serious challenges for supply chain operations. There are some who believe that if we just reduced our dependence on foreign goods, we would be insulated from such shocks and enjoy greater resiliency in our supply chains. However, the supply chain challenges that I described above were by no means limited to foreign suppliers, foreign ports, foreign warehouses, and foreign truckers. They were not confined to any one country. We experienced all of those difficulties in the United States as well. Even if it were economically feasible to produce all the goods we want in the United States at high quality and reasonable prices, it is not. The result would only be enhanced resiliency if the United States were immune to the ravages of such pandemics. It is not. Before we blame everything on supply chains, we need to consider an alternative explanation. The pandemic-era economy has been characterized by a dramatic expansion in the demand for goods. How could it be that goods consumption rose so sharply in the wake of such a powerful shock? We can look at three complementary explanations. First, there was the clear effect of health measures. When it became difficult to go to a gym or a restaurant or a movie theater, people instead purchased home exercise equipment, kitchenware, or entertainment centers. Second, in the wake of the pandemic, due to powerful fiscal policies, real personal income never dropped back to its level of March 2020, nor did the level of government social benefits. Finally, extraordinarily accommodative monetary policy, negative real interest rates, provided an incentive for consumers and businesses to move purchases forward in time, thus stimulating present consumption. Note that either an expansion of demand or a contraction of supply could drive up prices. However, only an expansion of demand would explain the additional quantity consumed. Had the supply chain been unable to deliver the goods, quantities consumed would necessarily have fallen. Instead, they grew significantly. By spring of 2021, durable goods consumption was up 35% on its February 2020 level. For imports, if we compare the fourth quarter of successive years, 2020 was 5.4% above 2019, while 2021 was 13.6% up from 2 years before. Those were record highs. None of this is consistent with an international supply system that has broken down. So what happened? The supply chain system was able to deliver significantly more goods in the face of surging demand, but it had its limits. The system has now been operating at or above peak capacity for almost 2 years. That has brought congestion, high prices, strains, and delays. One might ask, why did we not have an even more resilient system that could readily accommodate such surges in demand? The answer is that capacity is costly. For the public sector, there's a reluctance to allocate funds to build out infrastructure beyond any realistically anticipated need. For the private sector, the cost of excess capacity can drive companies out of business. On the subject of resiliency, there is no simple low-cost policy that allows an economy to gracefully accommodate very large and sector-specific surges in demand. In general, an efficient trading system that allows for flexible competitive sourcing is most likely to meet shifting demand. As a policy measure, this argues for an open, rules-based trading system. To conclude, the shift in preferences and a strong policy response induced an extreme and sustained demand for goods. The global logistics system was able to partially accommodate this surge in demand, even amidst operational difficulties. But global supply chains had and have capacity constraints. As surging demand hit those constraints, costs have risen, and goods have taken a long time moving from factories to customers. The resulting scarcity, along with pressures for increased production and hiring, have contributed to rising inflation. The measures most likely to ease supply chain pressures are those which curtail demand. The measures most likely to bring resilient supply chains are those which facilitate global sourcing. Thank you.
Thank you, Dr. Levitt. Start with you, Professor Spriggs. Your explanation about with the chip shortage and its impact on new auto sales and used auto sales and even auto repair was clear and concise as a major contributor to inflation. Thank you for making that, giving us that insight. If you answer these couple of questions, if you would, Professor Spriggs, would making more in America make our supply chains, would making more in America make our supply chains shorter and stronger? And how do we make sure we're better prepared for these risks and their impact on the supply chain and our economy?
Yes, it would make our economy more resilient because the supply chain, particularly for chips, turned out to be too highly concentrated. This is bad, even if it had been in the United States, because if it had been in Texas, the freeze that we had a year ago might have destroyed chip capacity. We don't want, as a global matter, to have this high concentration in a small set of firms in a small geographic space. We would be more resilient, the world would be more resilient, and the United States, as you mentioned, is the inventor of this technology. We need to renew our commitment to being ahead on that game. This is key to manufacturing. That would be like saying I don't want oil to say you don't want chips. It's that essential, and we have to guard that.
Thank you, Professor Spriggs. Professor Fuchs, your testimony, you mentioned the back and forth between among engineers and workers on the assembly line is essential to bringing innovation to market. The people coming up with ideas, the people executing those ideas need to be in conversation with each other. We lose that when corporations move abroad. Elaborate on why investing in a vibrant manufacturing sector is critical to retaining domestic innovation.
So I actually want to address two things in one. One is Senator Toomey's comment that there's a growing amount of manufacturing in the United States. That's correct, according to manufacturing value-added statistics. It's complicated because our proportion, A, what does value added measure? And B, what our proportion is of the global pie has been shrinking. I think the most important question, which comes to your question, Senator Brown, is what we don't produce, right? Which is why I focus on critical technologies and defense types of implications. So, for example, 90% of cell phones and 80% of computers are made in China. Is that okay for defense? Is that okay for our economic security? That's where I would focus our questions. I think that when we talk about, and our resiliency, when we talk about, I'll stop there, actually.
Okay, thank you. Dr. Stevenson, as you know, and as you pointed out well, some workers, especially women, were forced to leave their paid jobs at the beginning of the pandemic because of the lack of child care that made it harder for people to afford to go to work. People want to work, but they simply can't afford to with a child under 4 years old at home. The expansion of the child tax credit certainly helps workers afford child care. What additional action should Congress take to support workers, especially women, in reentering the paid labor force?
Well, the child care provisions in Build Back Better are necessary to strengthen our child care system. Child care workers are some of the lowest paid workers in the economy. A typical child care worker makes $12 an hour. It's impossible to hire child care workers at this point at that wage because, fortunately, the wages at the bottom have been pushed up. The problem for families is that if child care workers start to see wages that are competitive with, say, Amazon at $18 an hour, that's going to think about maybe a 50% increase in childcare for families. That's going to make even more families find that childcare is unaffordable for them. That means that there needs to be broad-based subsidies available for parents to be able to afford to work. I mean, and we really want to think about this. Can you afford to work? There is a long literature that shows that many women have paid to work in the past. By the time they pay their marginal taxes, by the time they pay for childcare, by the time they pay their commuting costs, they come out behind. As childcare costs rise, even more women are going to find themselves in that situation. And as an economy, we really can't afford to lose these women right now. We need them to come back. They provide essential services and produce essential goods in the economy, but they need the kind of support that families need to be able to afford high-quality investment in their children.
Thank you, Senator.
Thank you, Mr. Chairman. Dr. DeRucci, so let me see if I got this right. So over 2 years of 2020 and 21, money supply, M2, grew at about 40%. Federal government took on massive amount of new debt, spent a massive amount of money, more than offset lost income. Government spending was greater than the output gap. And if I understand correctly, your view is that all of this extraordinary money creation, new debt, and spending actually is the source of most of the inflation. Is that a fair characterization? And Dr. Levy, is it Levy or Levy? Levy, Dr. Levy. Some have still tried to blame inflation on supply chain disruptions, and President Biden, not too long ago, described our supply chain as being, quote, cut off. Our supply chain was cut off. So tell us about the state of our supply chain. Is it cut off? Is that what happened with our supply chain?
No, sir, it's not. The supply chain is working very, very hard at the moment. Now, it is experiencing delays. There's actually people working heroically in very difficult conditions, but an awful lot of goods are moving. It is not cut off.
So, in fact, are the ports through which we bring in a lot of the imported components of our supply chain, are they operating at record levels?
They are, and they're suffering from congestion. There's difficulty moving containers around, getting rid of empties. But yes, you're quite correct. They are operating at record levels.
So they're pushing more products through than they ever have before.
Correct.
Literally, that's what's happening with our supply chains. Now, even if that's not the cause of our inflation. It'd still be great if our ports could be even more productive, right? If they could put more products through, that'd be great. Tell me this: do American ports lead the world in productivity and efficiency?
Sadly, they do not. If you look at independent rankings of port efficiency, American ports don't tend to rank especially high. There's room for improvement.
Dr. DeRugy, do you have any views on what could be done to increase the productivity and the efficiency of our ports?
With the caveat that it's not my area of expertise, I mean, there's no doubt that there's a lot of room for improvement. As Dr. Levy has said, like when you look at most ranking, the U.S. ports never rank in the top 50. In fact, I went and looked at the World Bank's Container Port Performance Index, and not a single port made it to the top global 50 ports. And the largest U.S. port, Los Angeles and Long Beach, which account for 40% of loaded import nationally, ranked 328th and 333. And so I thought it was quite puzzling considering like we're a big country doing a lot of trading. And it seems that there is a fair amount of consensus about the fact that unions, could be one of the factors that reduce the efficiency of ports, not because, when they're on the job, they don't actually work a lot, but it's because through their contract, and because of labor purposes, they have reduced hours. They are very opposed to automation, and automation is one way to significantly create, increase in efficiency. And we can see it like a lot of our ports apparently are manually, the cranes are manually operated, which isn't the case in a lot of Asian ports. They don't function 24/7. It's hard. It's a hard transition from what we have now to what other ports have, but it's just we're far from what we could do.
So that makes it more expensive to process goods through our ports than it needs to be.
Absolutely, yeah. Well, and again, not my area of expertise, but it does look that it's not for. It's just pretty lucrative to work at a port, and so yes.
Now, my understanding is wages are extraordinarily high. Some of the highest labor wages in America are at our ports. What's maddening is the leadership of organized labor resisting the automation. You could grandfather current workers. You could make sure that nobody gets laid off in the near term, but you could ensure that at least in the future we would begin to catch up to sort of a second world level of productivity at our ports. That would be nice. I see my time has expired. Thank you.
Thank you. Senator Brown had to step outside for an introduction, so he's asked me to preside. I'll recognize myself. One of the major factors holding back the supply chain is a widespread shortage of labor. And while some of the labor shortages we hope to be addressed by the reopening of the economy as the pandemic recedes, I'm not convinced that will fully address the problem. Dr. Stevenson, can you briefly describe the effects of the labor shortage and where we are seeing the largest deficits?
Yes, so we are still missing 1.5 million, roughly, workers who haven't returned to the labor force. Let me put this in the broad spectrum, which is we've seen declining labor force participation for prime-age men for many, many, many decades. What's saved the United States has been the rising labor force participation of women, which has pulled us out of every single previous recession, with women's labor force participation growing faster than male labor force participation. That's not happening right now. And so it's crucial that we bring women back. I think it's also crucial that we solve the problem of declining male labor force participation. Some of that's about making sure that there is widespread availability of jobs, but also that workers have access to the training that will give them the good quality jobs that they can stay attached to, that motivate them to be in the labor force. I'm particularly worried about ongoing labor shortages as demand for services resumes. This committee's heard a lot about our big consumer demand for goods. We really liked our goods during the pandemic, but I believe we are going to want to go back to things like preventative health care, elective health care, enrichment, educational products. So when I say education workers, I'm not talking about government. I'm not talking about public school teachers. I'm talking about private sector. Right. All of that inflation is very, very low. Demand is low. If it comes back and the workers don't, that's going to be the source of inflation that you're having hearings about next year.
Yeah, and that 1.5 million you talked about that has not returned to the workforce is still falls far short of the nearly 10 million jobs that go unanswered in the economy today. A few weeks ago, Chairman Powell of the Federal Reserve testified before the House Financial Services Committee that part of the labor shortage is being fueled by an inordinately high number of retirements. We just don't have the workers to replace those who are leaving the labor force. Now, thankfully, immigrants are ready and willing to fill those jobs. In your view, what's the potential role of immigrant workers in mitigating the current labor shortage?
I think that Congress should take immediate steps to ensure that undocumented immigrants who are in the United States, particularly young ones, can stay and can work because we need them in the labor force. We are going to have to open our borders back up and welcome workers from around the world and welcome students from around the world back into our schools. That's a place where we get a lot of our innovation from, that sort of rich source of immigrant labor. So I think that's a very important part of expanding our labor supply.
You're not alone in that view. Leading business groups in this country agree that robust immigration reform is urgently needed to address our labor shortage. And I'm talking about not only in the question of dealing with undocumented workers, but even in terms of our visa process, so there is an enormous backlog. I wanted to ask Dr. Spriggs, the pandemic exposed or exacerbated disparities throughout all sectors of the economy, including the supply chain. Recent research from the University of Chicago's Booth Business School showed that customers delayed payments to their suppliers when their suppliers had a female or black trade credit officer at 10 to 20% higher rates relative to the payments to white men. Are you familiar with this or other research regarding racial or gender bias in the supply chain?
I'm not familiar with that specific study. We saw many disparities that we did not want to see with the payroll protection plan, loans, through the slow rate at which black workers were able to be rehired, despite the fact that many employers said that they were desperately looking for anyone. A number of these cleavages unfortunately showed themselves during this crisis.
What broader negative effects could bias in the supply chain produce for minority communities?
Well, this makes it harder for those businesses to survive in this setting, and it was very hard for them to get access to the liquidity to survive in this setting. Frictions in the economy hurt everyone. They drive up cost. And so we all lack because of that.
Yeah. So, Mr. Chairman, with just taking one community that I'm infinitely familiar with, the Hispanic community, largest minority in the country, growing exponentially. Fastest rate of growth of small businesses are Latina-owned businesses. But if they are disproportionately affected by our payment process in the supply chain effort and access to capital and all of those things, then the biggest growth faces some of the biggest challenges, which means at the end of the day, there are consequences for the country far beyond the community itself, and that's something I look forward to working with the chairman on.
Thank you, Senator Menendez. Senator Rounds of South Dakota is recognized.
Thank you, Mr. Chairman. First of all, thank you to all of you for coming in and visiting with us today. I want to take a little bit different tact. In South Dakota right now, January to January, we saw an increase of $1 a gallon in unleaded fuel. I think right now it's fair to say that the cost of fuel is up about 38% year to year right now. Clearly, that impacts the cost of transportation, the cost of production, and so forth. We haven't talked a lot about energy, and I'd like to bring that into the conversation a little bit. I'll begin with Dr. Levy. What would you say is, of the total inflation, let's just say rounded at 8% inflation, what do you believe the impact of these higher energy costs are in terms of the inflationary numbers that we're seeing right now?
Thank you, Senator. I don't have the numbers in front of me. You frequently get these numbers put out where they'll exclude food and energy and get to a core inflation, which is usually 1 or 2 percentage points lower. But that still leaves you at a very high number if you're starting at 8. So on the order of 6%, but I can't swear to a number.
Thank you. Professor Spriggs, I'm curious, what would be your thought with regard to how much the cost of energy is adding or is a part of the inflationary trend today?
We're going to just see the tip of that. As you mentioned, it's an input throughout the system, whether it's just to fuel the tractor, but then that tractor is then used to produce our wheat. So we're going to see ripples of that, but this is the point of overdependence on any specific energy source and why we must seek to diversify our energy sources. And we must make the investments to allow for the just transition of workers, not only because we need this diversification, but also because we know it's contributing to some of the global warming crises that we're seeing.
But
we
right
can't
now,
stop this right now, unfortunately, because...
But Dr. Spriggs, right now what we're looking at, and I recognize that we have to have energy from all sources, and we should be in all of the above. But what I'm curious about is right now with energy rises, or energy costs rising, and you indicated earlier that if you talked about chips and oil, and I think the similar thing here is we've got a shortage of chips right now, but apparently we have an increase in the costs of oil as well. Dr. DeRucci, I'm just curious, your thoughts with regard to inflation. And right now we're trying to split this up between the impact of demand versus supply, but where does our energy come into play with regard to the inflationary impacts that we're seeing today?
Thank you. So this is what I was saying earlier on, which is we have to be careful when you actually try to measure what is inflation and what isn't, to not confuse inflation, which is basically the rise of all prices, including wages, and that's and change in relative prices. And it is true that the cost, the supply shock of energy, this has reduced the supply of energy and has increased the price of oil and energy, is picked up in the inflation number. The question is it going up, month after month after month after month? And what happens when the supply shock dissipates? Is the price going to go down? The answer is very likely yes. With pure inflation, with inflation that is the product of demand and excess money printing and spending, you don't have, unless you unfortunately have very strong Fed action and Congress restriction spending, and I'm afraid some slowdown in the economy, you don't have these type of price that go down. So it's a big difference. So we always talk about all of this as if they were exactly the same thing, but once the supply shock, while it's painful right now, when it goes away, hopefully the price will go down. This is not going to be the case for a lot of other prices that have gone up because it's, of inflation.
Well, I just think that the fact that right now we've got an increase in the cost of energy right now, and that's impacting everything else. And as our economy starts to pick up again, the demand for the energy is going to be there. The demand for gasoline and so forth is going to be there. But most certainly, if we don't continue to increase the availability of energy in the United States of all sorts, we're going to continue to see that increase impact the prices that we pay for all products out there. Thank you, Mr. Chairman.
Thanks, Senator Brown. Senator Tester from Montana is recognized from his office.
Yeah, thank you, Mr. Chairman. This is for Ms. Stevenson. You talked about 1.5 million people are not returning to the workplace. And you said that women have bailed us out in the past and they weren't returning, and correct me if I'm wrong, weren't returning at a very fast rate. And you also spoke of childcare. Could you tell me, number one, if childcare is one of the major issues that is stopping women from returning to the workforce? Number one. And number two, what should Congress do about it?
Thank you very much for that question. Yes, childcare is a factor that is keeping women from returning to the workforce. I actually also want to add that it's having a big impact on fathers now as well. What we saw during the pandemic was childcare responsibilities impacted the employment of mothers and fathers. Women were more likely to leave the workforce in its entirety because of their childcare concerns, but in a wide-ranging survey of fathers, I found that fathers turned down promotions, cut their hours, switched to more flexible work, stopped training or upskilling. But parents were forced to cut back their work efforts. That doesn't always show up in employment, but it is going to show up in productivity as they switch to jobs that demand less because their childcare demands cannot be met in the market. I think it's also important to realize that both men and women are held back not just by childcare needs, but by elder care needs. We have seen a massive decline in employment in nursing care homes. That is partially due to supply. It's hard to find workers, partially due to demand. People don't want to put people in nursing care homes because they're worried about the health impacts. They need help with home health aides so that they can keep people at home and keep their jobs. In research prior to the pandemic, we found that most people who are caring for an adult are prime age workers, and a very large share of them are not in the labor force and tell us it's because they can't find a job with the flexibility they need to provide that kind of care. And additional research has found that if you put, for each adult that you gets access to sponsored home health care, you get about a third of an adult being able to re-enter the labor force. So you get 2 to 3 adults who need care getting
I got that.
access.
What I'm looking for, we know the problem, and I agree with you 100%. The issue is what can Congress do? And be very brief, because I need to talk about some supply chain and shipping too.
Sure, thank you. So Build Back Better actually outlines what you need to do when it comes to caregiving and home health care aids. So I think it's simple. Pass Build Back Better.
Okay, thank you. This is for Mr. Spriggs. Mr. Spriggs, or Dr. Spriggs, I'm sorry. You know what's going on in the ports right now from an agricultural standpoint. We can't get our exports out. And they're taking back empty containers. We've seen pre-pandemic container costs go from $1,300 a container to $11,000 a container for stuff coming into this country. And they're taking empty containers back. When we had a hearing on this in Commerce a few weeks back, antitrust smacked all over the room. Can you talk about whether we should be concerned about potential antitrust violations in the shipping industry?
Yes, I think you should be concerned. I think this is another one of those things that popped up. The United States has more market concentration than is true in some other countries. And it's part of the reason why prices have gone up more in response to these shocks than in other countries. And we saw this specifically when it came to shipping. As complicated as they keep their ownership, it turns out that's a highly concentrated industry. And it's not beyond the pale that some of this isn't those companies taking advantage of their market power.
All right. Well, I'm going to check out, but thank you guys very, very much. I appreciate it. This is a big issue, and it is entirely caused by the pandemic, I believe, when people were told to stay home worldwide. And we lived off inventory for a while, and that inventory is not there now. Thanks, Mr. Chairman.
Thanks, Senator Tester. Senator Warner is recognized from Virginia.
Thank you, Mr. Chairman. Dr. Stevenson, I want to come back to you. in your testimony, you talked about the need to increase funding for training programs and mid-career upskilling. I think we've seen literally over the last few decades, unfortunately, the private sector decrease their investments in training and upskilling. I think that's bad for the individual. I think it's actually bad for the company as well. I've been working for some time with very little success, unfortunately, on rethinking about the whole way we treat classification, tax, accounting, and reporting-wise on investing in human capital versus investment in tangible goods. I mean, I've got a bill that has been modeled on the R&D tax credit that would give that same kind of incentive for businesses to invest if you upskill an individual. I always cite, and with apologies to my colleagues who've heard me use this example a number of times, a company spends $5,000 investing in a robot, you get an R&D tax credit, the robot's an asset, you can put it on your balance sheet, you can brag about it if you're a public company. Same company spends $5,000 training two human beings to be better than the robot. You don't get the same tax advantage. It's viewed as an expense. There's no asset categorization. So this Investing in American Workers Act, something I'd like you to speak about it. Like also, I've been working with the head of the SEC, Gary Gensler, on robust human capital reporting. Again, something I think that most investors want to look at and need to make an honest assessment of a company's performance. So can you talk about these and other ideas to increase private sector investment in their human capital?
Thank you so much for raising this point, because I believe that it is incredibly important. We have seen companies invest less in worker skills. The fear that somebody's going to poach your worker after you've invested means that they don't want to invest. And we've also seen that we've seen declining public investment in a lot of these skills as well. And so we have workers, particularly those who are not graduating from college or advanced programs, but who need a very specific training so that they can be good at their job or that they can adapt to changes, just not getting those investments. You positioned it as either the robot or the worker. I actually want to encourage you to say it's the robot and the worker. Because if we look at what happened in the 20th century, America led the way in productivity growth because education kept pace with technological change so that our workers were able to take advantage of the new technology and use it to its highest productive capacity. And we had the glory days of productivity growth.
And let me just interrupt you. I mean, I don't disagree with you, but I think we ought to at least treat the investment class the same way.
Exactly.
I mean, the idea that you're going to, for years we had, abundance of labor and shortage of capital. We so favored investment in tangible goods over human beings. That balance has shifted back, and I think we at least ought to say investment in the human ought to be treated at least as good as the investment in the robot. And I don't think it's an either or. I agree it ought to be both. But that takes a fairly radical shift in our thinking.
And I would say we're far behind in investing in humans now. 21st century, we are behind most other OECD countries in investing in the skills of our people. That is not a place we should be. And if we want to take advantage of technology, we need to create the incentives for employers to be investing in their workers. And I think that would allow us to have skilled workers who can work better with technology. So I do agree that it needs to be on equal footing. I would actually even say I'd put the thumb on the scale of invest more in workers now, because our workers have fallen behind relative to other countries.
And I think back the R&D notion of an asset class back in the 70s was hard, I think, sometimes for accountants to wrap their head around. The idea that it would be fairly radical to think about investment in human capital as an asset class. But I think it's time to push that and let folks wrap their heads around it. It looks like Dr. Fuchs, are you trying to jump in on this one too?
I don't know if I'm actually allowed to, but if you call on me, yes. So I just wanted to, I really like your proposal to invest in humans and a tax credit.
Well, if you like it, you can jump in as long as you'd like. Keep going.
So what I wanted to emphasize, complimenting my colleagues' comments, is that some of the most advanced technologies advanced materials and processes, critical technologies, lead, if manufactured domestically, to more good jobs with more, exactly to Senator Brown's comment, more engagement by high school educated operators and technicians in the innovation process itself and getting the products out the door. So we need to strategically invest in those skills needed for those future technologies. And so I think thinking about how we're going to make sure we're investing in the skills of the future is going to be essential. I also continue to believe that the best way to build skills and manufacturing capabilities in the country is investing in the infrastructure of future. That brings in the ports concept, that brings in also the issue that Texas's grid going down led to some of the shortages in semiconductors that we're facing today. Not all of them. Oh my gosh, the shortages are so much broader than that. But if we improved our infrastructure, the resilience of our electric grid so that it's smart, it's resilient, it's dynamically capability, that improves cybersecurity, that incorporates renewables, we need to invest in that infrastructure of the future as part of our training
And
programs.
I know my time has expired, but I just want to add again, I think Dr. Stevenson said this notion that private sector is afraid that workers may be poached from each other. I mean, I wish we go back to, or potentially some of the upside of when somebody went and worked for the same firm for 30 years and that company felt an investment in that human being. I don't think we're going to reverse that. And so I do think we're going to need to think, frankly, more radically around asset class definition, tax, accounting, and I think some of these ideas are worth pursuing. Thank you, Mr. Chairman.
Thanks, Senator Warren. Senator Van Hollen from Maryland is recognized.
Thank you, Mr. Chairman. Thank all of you for your testimony today. And I know you've covered a lot of things that I was planning to ask about, but I do want to focus for a moment on the medical supply chain. And Dr. Fuchs, a couple questions for you, because we did see lots of bottlenecks when it came to our medical supply chain during the pandemic. PPE like N95 masks and nitrile gloves are essential to protecting our frontline workers, and yet we saw a big backlog when it came to supplying those. The U.S. market uses 55 to 60 billion pairs of these medical gloves every year, and yet right now only 1% of the world supply comes from the United States, despite the fact that a lot of these products were first developed in the United States. Now, some companies are moving to fill the gaps. In my state of Maryland, United Safety Technology just last week announced that it was opening a $350 million plant at a site called Trade Point Atlantic in Baltimore County. And it will bring 2,000 jobs to that area, leveraging federal government support through a $96 million DoD HHS contract. So my question is, clearly this is a step in the right direction, but how can we assure that as these investments are made, and when this pandemic begins to subside, that the downstream purchasers of these products don't simply go back overseas to something that may be cheaper, but also less quality, but also therefore make us vulnerable again if we're not supporting manufacturing here in the United States?
This is the million-dollar question, right? So we're talking about, in our original defense, the Act of 1990, which looked at the concept of criticality. We didn't have health in there. Obviously, the pandemic highlights the importance of health and more broadly, social well-being in addition to security and economic prosperity. The question then becomes, though, how much do we need here? How much do we need to be able to pivot, right? If Ford and GM in 2 weeks were able to bring up massive capacity for ventilators and for masks. So how much do we need our economy to pivot in order to move into that space? And how much do we need to create the new products of the future that are better, that everyone in the world wants, right? So I think those are all part of the solution. When we come to, and I know United Safety Technology from our research, when we come to these firms that pivoted during the pandemic into scaling and responding. There were issues they faced in terms of regulation that slowed them down, higher fees for good reasons. There were issues that they faced also in terms of having other types of support that they needed. And there are issues now in terms of, as you noted, being able to, that continue then and now, get into large-scale hospital distributors. I don't have an easy answer to you of how much we need. It's actually why I believe we need an entity in our country that is focused on critical technology analytics and that are cross-mission in order to figure out what is the cost and benefit. We're not going to make everything here. So what do we need to make sure, given the probability that it's going to be needed under an unknown future, how much do we need to invest to make sure that we can sort of resiliently respond? How much do we need to help companies to make the products of the future? And how do we make sure in certain cases that we're investing as a country, whether that be in better ventilation or that be in ensuring the demand for masks, that we have helped these people get into those broader distribution channels and also continue to produce product for our country.
Thank you. I don't know if any of the others of you want to comment on that question. Your assessment of the current state of the vulnerability of our medical supply chain. If not, Dr. Fuchs, thank you, because I think this is an area that we are going to continue to drill down on. But I'm pleased to see these investments, but as you indicated in your answer, we need to make sure that these are sustainable investments that fix the problem over the long term.
Yeah.
I would add, I guess, one thing, which is, your question was largely focused on manufacturing medical equipment, but I also want us to think about, workers who are working in medical fields where we actually see significant drop-offs in enrollment in certification programs and training programs. And so I think the challenges we're going to see along our medical supply chain may move from being the PPE and goods to the people who wear the PPE and goods.
No, I think that's a really good point. I'm glad you raised it. I had some other questions on sort of the workforce shortage issue, but I know some of those issues were covered, and childcare. And thank you, Dr. Stevenson, for your work on that. Thank you, Mr. Chairman.
Yep, thank you, Senator Van Hollen. Senator Warnock is on his way. We'll have a series of questions, but Professor Fuchs, you seem eager to answer questions, so I'm going to give you another shot. So I appreciate that. Your work advances the notion that by investing in domestic manufacturing, we invest in innovation and creativity. And I think one of the most important things to never forget in this is the contribution workers make on the shop floor or on the job site to innovation and technology and invention and all the things that workers can do. And I think that we probably underestimate that, as we underestimate and don't talk enough about the dignity of work and all that workers need at the center of our economy. And that helps us keep up with the changing world. So tell us more about how it will take a whole of government approach to build out the infrastructure to invest in innovative and creative technologies and make them here at home. How will that benefit us?
So I believe part of the reason that we have underinvested historically in manufacturing and in infrastructure is our inability to value the full value of those investments. So, for example, they don't only impact our security, national security. They don't only impact our economic prosperity. They also impact jobs. Those decisions also could impact climate. So if we take a cross-mission approach, we might actually, for example, in my work that I mentioned in the testimony on semiconductors for communications, those high-end semiconductors have better jobs, and having them domestically enhances our security. So why wouldn't we invest in them? So I think if we take that cross-mission approach, then we really would be investing more than we are currently.
Professor Spriggs, talk for just a moment or two about housing. We see, I was talking to some people from rural Ohio yesterday, about how we fall so short in rural areas and in urban areas in providing housing for workers that's affordable, that are housing that is affordable and accessible. Talk about the role that you see there.
One of the great challenges we have seen are trends driven by the growth in inequality. And we need to remember that markets are $1, one vote, not one person, one vote. At this high level of inequality, where the top 10% consume as much as the bottom 40% combined, it moves the price point on a lot of things, the things that the wealthy spend more on than the rest of us, housing being one of them. And so it sucks up the resources, and it makes it harder to make affordable housing somewhere else. So in rural areas, for low-income families who live in urban areas, they're priced out of this demand equation. It's important for us to recognize that and to find ways to make public investment in housing in rural areas as well as in urban areas so that we can put people back into the market, not just the dollars back into the market.
Thank you, Dr. Spriggs. Senator Toomey has a question, then we'll go to Senator Warnock.
And my question is for Dr. Levy. There's some who think that we need to have the government intervene in the economy to make up for what the free markets are doing wrong, and specifically onshoring economic activity. Some openly describe this as national industrial policy, which strikes me as a euphemism for having the government decide who they want to subsidize. But it's happening. I mean, the Exim Bank, for instance, has a whole new program where it's going to provide domestic financing, in some cases to companies that aren't even exporting. I guess they think we don't have banks in America that can provide that finance. It's unbelievable. But what are your thoughts on the wisdom of devising a centrally planned national industrial policy to deal with these problems?
Well, thank you for the question. I think it is not a new idea. It is an idea that has been popular for many decades. It's rather old. And as such, we've seen all kinds of problems with this idea. That one of the real challenges, knowing in what one should invest and picking the areas of the future is inherently difficult. If you do it in the private sector and you get it wrong, you go out of business. That's unfortunate, but that it happens. If you do it in the public sector and you get it wrong, there's been an unfortunate tendency that you keep going and going and going. And these tend to be sort of costly difficulties. So I think one needs to be extremely careful looking for instances where the public sector can outdo the private sector in these. And I think we've seen a lot of errors in that respect, looking around the world over the decades.
And Dr. DeRugia, did you want to add anything to that?
No, I agree. It's been tried many times in the past, and it's often did not deliver on the promise that were made precisely because the political system allocates resources not in the most effective ways. Very often it goes to special interest and that's the primary driver of the decision. And unfortunately, as my colleague has just said, it's really hard when mistakes are made to correct the path. There's extreme path dependency. When you name the Export-Import Bank, I've been following the Export-Import Bank for a long time, and you, Congress, have given the Export-Import Bank very different mission and goals ever since I've started following it, and yet the Export-Import Bank keeps doing exactly the same thing, independently of what you guys have asked it to do. So when it's convenient, it's like focus on China. Does it actually change the allocation of activities at the Export-Import Bank? Not really. Actually, it's always, Boeing's always the biggest beneficiary, and a lot of the same constituents in higher income countries, a place where capital is actually not that difficult to come by. And now, of course, while it has totally underperformed on the China goal, there's a new mission. It's a mission that is currently perfectly performed by private banks. And that raises a lot of questions about, whether it's going to actually really deliver on this. And I doubt it, precisely because of this path dependency.
Thank you, Mr. Chairman.
Thank you. Senator Warnock from Georgia is recognized.
Thank you so very much, Mr. Chairman. Georgians are hurting and are dealing with the rising costs of basic things like clothing and medicine and groceries. And as someone who's home every week dealing with families, as their senator and families in my church, I see this up close. Families need immediate support as we're dealing with the rising costs that are a consequence of a pandemic where the economy was slowed down significantly, supply chain issues, and corporations artificially raising prices. And that's why I introduced the Relief for Families Act. This legislation would cut costs of essential goods for hardworking families by allowing states to use their American Rescue Plan dollars to offset sales tax holidays on essential items like groceries, school supplies, diapers, and other household goods. This is a win-win because it's covered by revenue or resources we made available through the American Rescue Plan. States don't have to take it onto their budget. It won't cost the states or the federal government any additional money. It's a no-brainer investment in working families. Dr. Stevenson, my bill would cut taxes on essential goods like food, diapers, and clothing. Can you tell us who is likely to benefit most from a policy like this?
Yes, thank you for asking. I think that's an extremely well-targeted policy because who's going to benefit most are going to be the families that spend a high share of their budget on essential items like food, diapers, and other necessities. It's also the case, so is how economists talk about it, we think of that as having very inelastic demand. You pretty much have to buy those things, even if it means really sacrificing spending elsewhere. Well, that also means that when it comes to tax incidents, like who sort of benefits when you cut the tax, it's going to be those families that benefit rather than the stores. So I think it's a really good way of getting money back into families, and it is specifically targeting those families that spend a high share of their budget on essential items, and those are, by definition, lower income families.
Right. So these are ordinary folks who don't have a wide margin, and they will, as you point out, these are essential items. And so as the economy opens back up, how important are policies that keep costs down for working class and middle class families? How important is that for them and for the larger economy?
Keeping costs down for low-income families is critical because they spend all of their money now. They don't have a way to hedge against inflation by putting it into some inflation-protected asset because they're using their money to live right now. They're the ones who are dealing with higher prices at the pump, higher food prices, higher energy prices, because these are a really big share of their budget. So anything you can do to offer relief to families, I think, is really critical. And one of the things we saw disappear this year that's been so hard on families is the end of the expanded child tax credit.
Mm-hmm. Yeah, I agree with that, and I would hope that we could extend the expanded child tax credit, the largest tax cut for working and middle class families in American history. Tax cut for ordinary folks, this federal tax holiday, another tax cut for ordinary folks, which is why I'm glad we were able to pass the American Rescue Plan, and just the other week claw back prevent $400 million from being clawed back from people of Georgia, so we could fund this kind of thing. Gas prices, of course, is another issue that folks are struggling with. And during the past year of supply chain disruptions, we saw ocean carriers use market volatility to increase their profits by 2,000% in the middle of a pandemic. This is why I called for a federal investigation into shipping carriers' corporate greed. And I'm happy to see that the Department of Justice answered my call and has subpoenaed Maersk as part of a probe into supply chain disruptions. These types of corporate greed have significantly affected our supply chains for years. Dr. Spriggs, what effect has corporate greed and market consolidation had on our supply chains and manufacturing? Has it, in fact, raised costs for families, pushed down wages, made the economy less resilient, in your opinion?
Yes, we need to do more to police market concentration. We know specifically, you had mentioned food, that this has been critical. Cattle ranchers aren't any happier than those of us buying beef. Neither one of us are smiling at this price. And the risk that the workers were put through in producing this meat, the reckoning hasn't come for that. We've characterized this disease so much as the loss of those who were elderly, but we forget how many workers died among the million Americans who have died from this disease. In Georgia, your state in particular, the disproportionate loss of Black life was Black workers in food processing. And so that market power seems to also protect them from the kind of steps that we needed to take to protect workers. So yes, we need to do a lot more about the market concentration of power.
Well, thank you so much. I think it's past time for us to hold corporations accountable for price gouging in the middle of a pandemic of all times. And I'm glad that we're thinking about ways to invest in an economy from the bottom up rather than waiting on resources to trickle down. Thank you so much.
Thanks, Senator Warnock. Senator Sinema from Arizona is calling from her office.
Well, thank you, Mr. Chairman, and thank you to the witnesses for being here today. Global supply chains are comprised of complex working relationships between private businesses. When they get disrupted or broken, they have ripple effects, and there's very little that government or really anyone can do to fix it in the short term. We're seeing higher prices at the pump, in restaurants, and at the grocery store, and working families feel the pinch the most. Arizonans continue to tell me that supply chain disruptions and inflation are their top concern. Now, the global pandemic and Russia's illegal war in Ukraine stretched and broke the fragile supply chains of businesses around the world, and Arizonans and Americans are dealing with the consequences by paying higher prices for fewer goods. We need to work together to find solutions that bring down costs and make it easier for families and small businesses to make ends meet. Dr. Stevenson, thank you for being here today. Prior to the pandemic, many businesses employed an operations strategy that minimized the amount of slack in their supply chains, usually by eliminating what was seen as excess inventory or capacity. The goal was to lower holding costs and production costs to increase net earnings. Can you speak to the fragility of these types of supply chains during the pandemic?
Yes, thank you. I mean, I think you're highlighting the fact that there were some gains that came from this idea of just in time, but as soon as we have delays, that just in time means empty shelves. And that created a set of fragility that meant that, you know, everyday items that consumers wanted to buy just weren't there. And I think it's, you know, something that people panic about a little bit. You know, some of the price rises we've seen have come when people overbuy because they're so terrified they're not going to be able to get their hands on things because they saw empty shelves. And, you know, many stores took action to try to calm people down. But I think there's another aspect of that just-in-time attitude that I'd like to really highlight, which is that just-in-time for workers. So workers are sent home when turns out there's not enough customers, even though they've already paid for the childcare they needed to be able to work that day. They're given insufficient hours because they're, you know, trying to hold on to excess capacity of workers just in case we need to be able to ramp up production. I'd like to be able to give people more hours, and so they keep people sort of at under hours, and they provide them with their schedule with insufficient notice. All of those ways of sort of treating business as if what they want to do is operate on the absolute slimmest of margins, but taking it out really out of the consequences for that are paid by workers. I think the way to build more resiliency is for our businesses to understand that they need to invest in people and long-term relationships with them as well as with their suppliers.
Well, thank you. Now, Dr. Levy, I'd like your thoughts here as well. Do you agree with Dr. Stevenson, and do you think that operation strategies for global companies need to adapt moving forward, where businesses should plan to have more slack in their supply chains to anticipate volatility and avoid disruption for consumers?
Thank you, Senator. I think there are very difficult trade-offs there. It is costly to hold inventory. One can get caught in the other direction by having excess inventory that is no longer needed or just simply isn't consumed. But you're right. If one errs by having too little, one can get caught by surprise. And we've seen some companies actually anticipate some of these things. Like you've seen some of the semiconductor industry very recently have noble gases on hand, which sort of insulated them against a cutoff. So I think this is a major consideration that businesses are now thinking about.
Thank you. There's a lot of conversation about increasing domestic manufacturing in critical products like semiconductors. Our Bipartisan Chips for America Act supports domestic semiconductor manufacturing, and it was funded in the bipartisan competition bill. We want Congress to pass our law ASAP to build more resilient supply chains here at home. But repealing outdated tariffs like aluminum is another way to lower prices and shore up supply chains. Dr. Stevenson, if we ended the aluminum tariffs today, how soon would we see a change in prices?
Well, markets react quite quickly to news, and I think markets would react quite quickly to the news of eliminating tariffs today. While that may take a little bit longer to get to the end to consumers, I think you would. I do think you would pretty quickly see that show up in prices.
Thank you. Another approach is to redesign our supply chains to bring them closer to home to reduce the potential for major disruptions. Mr. Chair, my time has expired, so I'll submit my additional questions for the record.
Thank you, Senator. Senator Reed from Rhode Island is recognized.
Thank you very much, Mr. Chairman, and thank the witnesses. One of the issues that is causing great inflationary pressure in Rhode Island and across the country is rent and the cost of housing. And to Dr. Spriggs, what steps can we take to ease import costs and increase the housing supply so that it's affordable?
Thank you. So part of what's going on in the housing market right now is they are having supply problems also, so they're not able to produce as many homes as they would like. So part of it is us getting through those. But part of it is, again, recognizing that it is a market and we need to have public investment so that the investment matches people. Housing as a private matter matches dollars, and dollars are not equally distributed. As long as you're going to have a market dominated by 10% who consume as much as the bottom 40%, you're going to have a lot of people outbid on housing. And so we must recognize that public investment in housing is a necessary tool to make sure we get the proper level of investment. We have long had a low-income tax credit. We should think of ways that we can use that. We have a lot of us who believe in a global minimum tax, and we need to find ways that that low-income tax credit can still be effective even in the face of a global minimum tax. And we need to make sure that we raise the wages of workers. Fortunately, 21 states have been raising the minimum wage this year. In January, the majority of American workers got a raise at the bottom. That's a large part of what's fueling not only the called the Great Quit, because when the minimum wage goes up, turnover goes up as well. There's a ripple effect that goes on that makes people switch jobs more and workers get a higher wage. But we need that $15 an hour legislation to be in place, and we need the PRO Act. We need to have workers with the right to organize so that we can get wages back up to go along with the productivity increases that are coming from the automation and the improvements in productivity that are being put in place.
Thank you. Dr. Stevenson, would expanding training and apprenticeship programs for building trades increase labor supply and also contribute to ease housing prices and rental prices?
Absolutely. I mean, one of my biggest concerns is that we see an ease in the supply chain constraints around the materials, and then you can't find the workers. We need the workers and the materials to be together, and there's lots of reasons to think that we're going to find ourselves without enough skilled tradespeople to be able to produce that housing stock. And obviously a really great way to do that is through apprenticeship programs and vocational training.
Thank you. And Dr. Spriggs, there's been some discussion of targeted federal financial assistance for grocery and gasoline costs, which for low-income families are some of the biggest expenditures, perhaps something like a debit card that is exclusive for those items. And would that effort, coupled with pay force by increasing the tax on very, very wealthy Americans, make sense?
In this situation, absolutely. We don't want to exacerbate aggregate demand, and offsetting it would be a great way to make that happen. It would be a great way to target it to those at the bottom. Going forward, we know that we're going to have disturbances with food prices because of global warming. It would be nice to have a trigger so that SNAP benefits could adjust automatically when we get these kind of disturbances. At some point in the next 15 years, we're going to get a major flooding of our Mississippi Valley, and we're going to have huge disruptions to corn, hogs, beef, as well as the transportation of those goods. And we should be ready beforehand to make sure we can give people relief from those price shocks.
We also have an ongoing disruption in Ukraine with wheat and fertilizer, which will be reflected, and I think first in the developing world, because we can outbid them for the supplies, but we won't be immune from that either. Well, thank you all very, very much. Appreciate it.
Thank you, Senator Reid. Thank you, all five of you, for joining us today to talk about how to build more resiliency into our supply chains and into the economy. Senators wishing to submit questions for the hearing record, those questions are due 1 week from today, Tuesday, March 29th. To each of the five of you, please submit responses to those questions for the record within 45 days from the time you receive them.